Well, stocks slipped last week as tariff headlines were thrown around all over the place, and headwinds facing the AI sector mounted as well, while haven demand drove a bid into treasuries and also helped the dollar to gain ground as well. Once more, trade is in focus as the new week gets underway, with Trump throwing tariffs around all over the place. Will he or won't he on Mexico, on Canada, or on China, and maybe even Europe as well? But besides that, there's also plenty else for market participants to digest this week, including, of course, Friday's US labour market report, earnings from Amazon and Alphabet, plus the BOE set to cut rates on Thursday as well. Plenty for us to discuss on the trade-off this week. So without further ado, let's get on with the show. Well, it certainly hasn't been a quiet start to the new trading week. We came in on Monday morning with Trump having thrown 25% tariffs on Mexico and on Canada. And by the time we went to bed on Monday evening, neither of those were taking place anymore. Joining me to try and make sense of the roller coaster ride that markets have been on over the last 24 hours and are likely to carry on with over the next week or so is my good friend Ryan Littlestone from Forex Live and Forex Analytics. And Ryan, it's not only been a roller coaster for markets, it's also been an emotional roller coaster for you over the last day or so with that West Ham performance last night.
Oh, here we go. You had to drag it up, didn't you? Yeah. Oh, I don't know. Is it Friday yet? I feel like I've worked a week yesterday already. It's just we keep coming in on a Monday or coming in any day, and it's bonkers markets again, and it's good fun but tiring.
Yeah, I'm not sure fun is the word I would use, but I would certainly agree with the exhausting sentiments. You know, it does really feel like we've done a whole week's worth of work and it's 9:10 on Tuesday morning. But nevertheless, we shall push on regardless in the interests of our viewers and crack on with Topical Thunder. So there's only one place we can start, really, which is with the issue of tariffs. And I mean, where the hell do you begin with this? Let's go back to Saturday night, first of all. President Trump, he'd been talking for some time about putting a 25% tariff on imports from Mexico and from Canada, and also an additional 10% levy on goods coming from China. Well, there was a lot of sources reporting, will he do it, won't he do it? It turned out he would do it with those tariffs announced on the 1st of February. Of course, market participants then came in Sunday evening, Monday morning, big move higher in the dollar, lurch lower in risk as a result, and also a big lurch lower in some of the trade sensitive currencies like, of course, the Canadian dollar and also the euro, with market participants going, Europe must be next on his list. That said, as Monday progressed, things became a little bit more conciliatory in terms of the tone. Firstly, we had news that the tariffs that were due to be in place or put in place on Mexico, they were being postponed for 30 days. Then, as the day progressed, we had news that the tariffs that were due to go into place on Canada, they were also being postponed for 30 days, ostensibly after Trump had won some concessions from both Mexican President Sheinbaum and Canadian Prime Minister Trudeau, although, of course, we will see whether or not those concessions actually come to pass. On the issue of China, well, they're not quite as lucky. The tariffs there have indeed gone into place in the early hours of this morning, and China has within seconds thrown a whole load of retaliation onto the table as well. 15% tariffs on energy imports, a whole host of 10% tariffs on other metals. They've also added a few US firms to their unreliable entities list, and in a move that is probably not a coincidence, they have also announced an antitrust investigation, easy for me to say, into Alphabet, who, of course, reports earnings this week as well. Now, I think there's a few things to digest here and a few takeaways. The first is that whatever Trump and his allies say, this is nothing about trade balances. This is nothing about trade deficits. Tariffs are just a negotiating tool at this moment in time. And I think we may have even touched on this last week. The way this seems to work is Trump's going to sit there and throw a tariff on a nation and hope that that brings them to the negotiating table. If it doesn't, then he's just going to ramp up those tariffs more and more and more until the other party come to the negotiating table, and ultimately until he gets his own way politically. Now, of course, the implication for this from a market perspective is that we are seeing a barrage of headlines, and I don't use that word lightly. It is pretty relentless at the moment in terms of the news flow that we're seeing. And unsurprisingly, you see volatility move higher and uncertainty move higher as a result, because it's almost impossible to discount a future path for fiscal policy, because there just isn't one to discount at this moment in time. And I think in terms of what this means for market participants more broadly, and Ryan, I'm obviously keen to get your views on this. I think the three takeaways that I would have is, one, it's still very tough to be sitting in any short dollar positions for a particularly long period of time, with tariffs just being thrown around left, right, and centre. The second is that I'm actually starting to look a little bit more cautiously at equity market longs. Yes, I'm still a bull over the longer term. I think the path of least resistance does take us higher this year, but I think the risk reward just isn't quite there right now to be buying the dip in equities. And I think the third thing is that safe havens are likely to stay in quite heightened demand, and actually safe havens that aren't exposed to potential tariffs. And of course, that naturally leads one to gold, which, as we speak, is trading at fresh record highs. And you would imagine that the yellow metal is going to continue to shine.
Yeah, this story is multifaceted, really, isn't it? I mean, headline trading is back. And as someone who used to trade on the live floor, where all we had was a couple of screens with news headlines popping up, trading headlines was my bread and butter. And it's nice to have that back again, because it's been very difficult over many years to trade headlines because of algos, robots, and the like. Everyone can jump on it much quicker than we can now. But we're back to trading headlines, and there is good opportunities to get in amid some of those headlines. Last week was a perfect example. It all kicked off when I can't remember who it was. Someone put up a story saying that these tariffs were going to be delayed until March, and everything reversed, or dollar CAD all dumped off, trading 143. An hour later, Trump press secretary, whoever it was, came out and said, nope, that's rubbish, and we're up 200 pips. And there is opportunities, if you're catching this sort of stuff on Truth Social or whatever, to get in right at the ground floor, if you like, and catch these moves before they happen. But that's something for full-time traders, perhaps, who happen to be in front of their screen all the time. Very difficult for part-time traders to trade those sort of moves, and then you feel like you've been left out. But going back to the tariffs themselves, yes, we said it right at the start of the year, our first show. This is what, even before then, this is what Trump is aiming for. Come in, hit people with tariffs, hit people with threats, get them to the table, get what he actually wants out of them. And what happens is that it becomes a calculation, really, for other countries. Can they afford to go up against Trump, retaliate, not bow to his demands? And they add up the costs, and it all comes down to money. If they can afford to do so, they will do. If they can't afford to do so, then they'll bend and they'll come up with a deal and avert tariffs. But the last thing I think is that what we've seen, particularly this weekend, coming into this week, is that we've got a little bit of a change in markets now. You talk about risk. Came in Sunday night, looked at the open, dollar CAD's off 150 pips, up 150 pips, cables off, euros off 100, 200 pips, whatever it was. Dollar yen, 13 pips. It was up 13 pips through all those moves. Same with the Swissy. So we're seeing a bit of divergence happen now, like you say, between the countries who are in the crosshairs for tariffs and those who are not. We know that Japan always played ball in Trump 1.0. They got a deal, Abe playing golf with Trump, best of mates. They avoided tariffs. The UK as well, we might avoid tariffs because we don't obviously do an awful lot anyway with the US, but we've got a good relationship. So we're going to see that divergence in different currencies, different areas where we're not going to get the big moves we're going to get in the likes of CAD and MEX. But it's all fun and games, and you've got to be on your toes for this one.
Yes, most definitely. And of course, this is something that I think is probably going to be topic number one for, well, the next 3 years and 50 weeks, depending on how long we both do this show. Anyway, moving on to more pressing matters, perhaps, and that is the monetary policy decisions that we had last week.
Yeah, obviously we had several central banks, the Fed and ECB included, go talking about the Fed, I think it was another masterclass from Powell, as we were pretty much expected. He pretty much left us no more enlightened going in than we were coming out. The Fed stopped cutting, and we still don't know if it's a skip or a pause. He even managed to remove the line about growing confident on inflation getting to target and talk it down as just a language change rather than a hawkish omission. Now, the market has...
Well, hang on. That's not quite the line he changed, was it? There was no mention of confidence. The line that changed was inflation is moving towards 2%. That's the bit that took out. The moving towards was taken out. And actually, maybe I'm the mug here, but I do believe what Powell was saying. It's not uncommon at the January FOMC to have that kind of clear up of language and just straighten things out for the new year.
Are you sure? Because I thought he took out the growing confidence bit as well. I'll have to go back and read that.
Well, we can sort that out later on.
Yeah, we'll have to do that as an edit later on. So more work for Kyriakos. But anyway, it was an omission, and you can't just change statements and like that and say it's a language change, because why is it in there in the first place? But anyway, we don't know. We come out no further better knowledge of what they're doing, whether it's a skip or a pause. But the markets have made a decision now, and it now sees a pause until June at the earliest in the pricing, and then only total of 2 cuts this year. Now, I said these early New Year meetings were important for markets and trading wise. That gives us the expectation trade to go work with over the next few months, because the market is now set up for looking at June. So anything that changes that perspective data wise or otherwise is going to give us the market moves. Looking at the ECB, it's probably one of the dullest ever, and that's a very, very low bar. But the sources story afterwards was far more interesting. Now, I mentioned last week I was looking for any hints of a possible pause from the ECB as well. And while nothing came in the meeting, the rumour is that they will potentially cut again in March and then have a deeper debate over what they do in April, which the market's taken to insinuate there might be a bit of a pause coming then. Now, the March meeting, we get the new updated ECB forecast for what they're worth, obviously. So that will add or subtract from these rumours. Now, some ECB bods since then have been pretty dovish. We've had one of the hawks, Casimir, saying they're not quite there on rates, and Simkas, he's looking for another cut and then 2 or 3 after that. So there's still a lot of doves coming into the ECB or sitting in the ECB, but I think they're going to have a bit of a bum fight with some of the hawks now, the more they cut, because we're slowly getting towards their neutral rate or areas that they're going to call it. And we get an update on that at the next meeting as well. The staff has given us their range, which will probably be -5% to +5%, knowing those plans. But one thing I've noticed through all this, even taking the tariff moves aside, that the euro has been holding up relatively well after both those meetings, the Fed and the ECB. Obviously, a lot of that's changed with the tariff noise. But the question I want to ask for you is that if you take out that tariff noise, that side of things, will a ECB pause put a firmer bottom in euro-dollar, do you think?
Well, I'm not sure. Firstly, I'd say I'm not sure we're going to get an ECB pause for some time. I mean, I think they're going to deliver a 25 basis point cut in March, and that will get the deposit rate down to 2.5%, which, all jokes aside, is probably right at the top end of where you would say neutral is in the Eurozone. I think Lagarde has pinned it between there and about 1.75% as her sort of rough estimate. But as you said, we'll get those staff forecasts at some point soon anyway. So I think the ECB are probably going to deliver another 2 cuts at the very least, maybe even 3, before they start thinking about pausing that easing cycle, particularly as those trade risks mount. And I think actually what you'll see is, yes, there will be a greater divergence of views, but Lagarde will still just kind of manage to force her own way through anyway. But setting that aside as well, I think, yes, I think the euro is probably at or moving past that kind of peak pessimism point at this moment in time. You think about the amount of negative headlines that there've been over the last few weeks. Lagarde saying last week it's premature to even discuss when and where to end the easing cycle, the trade nonsense that we had to kick off this week. In France, you've got 4 no confidence votes happening this week on consecutive days. And the euro just doesn't seem to be particularly bothered by any of it. So I would actually argue, and I know I've had this view for a little while now, that the balance of risks actually tilts to the upside at this point, barring a significant negative external catalyst emerging. I think the euro has probably priced in about as much bad news as it needs to at this stage.
Yeah, I can probably agree with that. I still think the risk is that the euro heads lower, just as the fundamentals play out. If the US remains strong, if Europe remains in this slump, then you're going to see that policy divergence continuing, and I think we're going to be eventually heading back lower. But markets move two ways, and I wouldn't rule out a bit of a bounce in the euro over the next couple of months.
Indeed, time will tell. Right, moving on to another policy decision, which is coming up this week, and that is, of course, the Bank of England, just down the road on Threadneedle Street, expecting a 25 basis point cut from the old lady. Well, it's a long way from you, mate.
Just there in the background, look. Just about
right. What are we expecting from the BOE this week? A third 25 basis point cut of the cycle. That would lower bank rates to 4.5%. It's unlikely to be a unanimous vote among the 9-member committee, though. I would expect that it's going to be an 8-1 decision, with just Catherine Mann dissenting in favour of keeping policy on hold, although there is perhaps a slim chance that Megan Green does join her in that dissent. It is, of course, worth noting that the decision in December to keep bank rates steady was a relatively narrow 6-3 vote, so it's not really going to take too much to shift the remainder of the committee in favour of a cut this time around, which of course money markets do fully price in. In terms of the policy statement, the guidance is likely to be pretty unchanged, to be completely honest with you, with the MPC sticking with a gradual approach to further policy easing and also continuing to focus on signs of inflation persistence within the UK economy. And remember, although we did have that better than expected December CPI report, there were a few statistical quirks that were skewing that. So I don't think policymakers will read too much into the data just yet. The bank's new forecast, they're likely to see GDP growth expectations revised lower. Q4 of 2024 was pretty dismal, and I think the new year has started in similarly soft fashion. We might also see a marginal upward revision to the inflation path, and that is, of course, as implications of October's budget continue to become clear. All in all, I would actually argue, though, that a hawkish BOE, while it is absolutely the correct policy stance for them to be approaching and obtaining, because their mandate is to get inflation back to 2%, it is also probably the absolute worst policy stance that the UK economy could need at this moment in time, because of course you have the BOE remaining hawkish, you have growth which has pretty much fallen off a cliff, you have inflation which remains elevated and which remains stubborn, and also you have a government which has next to no fiscal headroom, meaning that further spending cuts are on the cards at the back end of March. In other words, it is stagflation, and in my view, that is simply not bullish for sterling or for any UK assets, really.
No, absolutely, and I use the analogy often. You can probably nail it to the wall of the Bank of England that they're between a rock and a hard place, always facing inflation problems and then the lack of growth on the other side. I don't know whether to be a bit surprised that 8-1 vote. I can see them cutting 25 purely on the basis that the economy is softening. They are still very restrictive. They've got the room to do a little cut without upsetting anything, and as I say, they can keep restrictive. We know that perhaps Breeden is jumping the line. Her last comments coming into this year were that she sees reasons why we can be less restrictive. So she was a holder at the last MPC, so she's going to jump the fence probably. I don't know. I don't know if an 8-1 might send too dovish a message, and maybe they'll want to do a 7-2, maybe a 6-3 the other way, just to keep that optionality in there. But either way, I think, as I say, they're stuck. Do they keep combating inflation or do they react to growth? The government's no help to them whatsoever, like you say, in terms of what they do. But this also plays in, because I want to look at euro sterling for this one as well, because there's two things to look at here. Firstly, going back to the tariff situation and talking about which countries are in the firing line or not. If we look at the chart here, euro sterling, coming into 2025, we had this these worries about the UK, about the government, the fiscal space and everything, yields going. And we saw, the pound really weakening and euro sterling rising, right, sort of back up towards a big area at the 85 level. And then a little later on, we've had the government going on their growth bus, if you like, jump on the growth bus. Now suddenly the UK isn't such a bad place to invest in and changing their mood. And then we've seen the pound gaining some. Obviously, then we've had this weekend all the tariff situation where Europe is firmly in Trump's sights. And so we're seeing negative moves in the euro. And again, that shows you that this move down, this complete reversal basically in euro sterling, is down to that threat more so than the UK side of things. So what does that mean for trading the Bank of England? Well, this is something I want to point out, that if we're being country specific about tariffs and such, but we also have to deal with central banks and what they're up to. If we know that the euro is soft on the tariff threat, we get a dovish Bank of England, we're going to see euro sterling probably rising. Now, you might think, well, there's your opportunity. The tariff threat's still there. The Bank of England's cut rates, so that might be a move worth fading. So it's important to, when you're trading, look at the fundamentals, what's going on in central banks' economies, because that's always going to be there. And then you adapt it to what's going on with this headline trading and see if that gives you any of these opportunities. So if you're talking euro sterling, yeah, I think another decent rally in here over the Bank of England. I might be looking to short that on the tariff threat.
Yeah, mate, you're right on that one. Just lastly on that, the government growth bus that you mentioned, let's hope it's powered by hot air, because then we'll all be saved, because that's all we seem to be getting at the moment. Anyway, moving on, because besides trade and besides policy decisions and besides earnings, it's a busy week on the economic calendar as well.
It is, isn't it?
I'm
Sorry?
I was wondering if you were all right then.
I'm taking a breath, mate. I'm knackered even doing the show. Yeah, we got tons of data. Remember that data? Yeah, cool. Forgot about that. But somewhere during this tariff war, we are trading through a lot of data as well, particularly this week. And you can't ignore the data just because the market is moving on other things. The fundamentals, as I say, still matter. And when we're not trading the headlines, the market's going to revert back to that. So this might give you some opportunities, as I said just previously, to trade some of the data moves against the headlines. So what are we getting? Well, today we get the JOLTS numbers, which are a bit lagging. They're always a month behind, but being jobs week, the market likes to move on those. Then Wednesday, we get some of the flash and final services PMIs, as well as ADP jobs and the ISM. I know you love the ADP report, Michael.
Oh, it is my favourite release.
Yeah, I should get a guess out of you for that as well, I think. Thursday, we get European retail sales, which if Germany's anything to go by, they're not going to be much to write home about. Then we get the Bank of England, as already mentioned. US Challenger layoffs, something I have been keeping an eye on recently, the last few months, just to see if we are getting any little cracks appearing in jobs market, anyone laying off any big companies, any big layoffs. And we also get Q4 US non-farm productivity and labour costs. Now, that's a metric the Fed watches pretty closely, and those labour costs are expected to come in up a whopping 3.3% from a prior 0.8% in Q3. So that would be the highest since Q1 last year. So something, again, to say the Fed are going to be focused on. Friday, it's all about jobs. We get both the Canadian and US employment reports. Now, Canada had a bit of a blowout last month, came in with a 91k gain and is expecting another 26 to be added in the jobs market this month. The unemployment rate, though, is expected to tick up to 6.8% from 6.7%. Non-farm payrolls expectations currently running around the 150, 155 mark versus the 256 we got last month, which blew out expectations, which were around 165k. Now, the unemployment rate in this one is expected to stay unchanged at 4.1%. So we're not expecting any horror stories from the jobs market. But I've got a little bit of caution to put forward that maybe, just maybe, we might see a few wobbles from the storms and the weather and the fires that we've had over there, though it might have missed the survey date for this one. We finish off Friday with the flash Michigan consumer survey. And importantly in that, we need to look at those CPI expectation numbers. That saw a big drop, a big jump last month. And we've had the Fed talking about how they think inflation expectations have been anchored. But in a lot of these surveys, the Conference Board, Consumer Confidence, Michigan, PMIs, prices paid, we've seen a lot of inflationary pressures still there. So something to keep an eye on. So apart from badgering you for your number, mate, is there any assets that you're looking at that you fancy for the data this week?
Well, you'll get my non-farm payrolls guess as usual at midday on Friday. Yeah, there's a hell of a lot going on, isn't there? Let's be honest. I think my broad takeaway from all of that is actually I wouldn't be surprised if there's so much noise that the market really struggles to extract much by way of signal from most of these releases, particularly when it's difficult to imagine them materially shifting the policy path. I mean, you take the non-farm payrolls number on Friday and the jobs report out of the States, for example. Powell said last week that to cut again, they need to see real progress on disinflation or labour market weakness. Now, unless we get a report that is miles away from consensus, which would probably be shrugged off as a one-off anyway, we're not going to see that real labour market weakness. There are, though, as you said, some downside risks to that payrolls print. Obviously, the wildfires, which are going to be incorporated by the survey week. Also, the weather in the survey week was extremely cold across the United States, and that's likely to have depressed employment in sectors like construction. So you are looking at a potentially downside risk to that 160, 170k consensus. The Canadian jobs report, I mean, all focus there is on tariffs. So I don't think that's going to move the needle too significantly. I think it's more a case of trading around the data and trying to fit that in around all of the barrage of trade and other headlines that we're likely to get, which are going to be by far and away the most significant influence on markets this week. But yeah, I certainly don't expect any dramatic repricings on the back of the data we're getting, which is surprising because it is a busy week of tier one releases, and you're kind of sat here saying the logical thing is that none of it's actually going to do much to markets, but sometimes markets are illogical beasts.
Yeah, absolutely. And I think, as I said just earlier, you've got to look at it from the point of view, see what's happening with the headlines. If Trump's stamping all over Canada again, and we're seeing dollar CAD run into the highs, and we get a good jobs report and a weak US jobs report, then that dip might be something worth buying. Yeah, we can only take these points as they come. It's a bit folly to pick a plan right now.
Yes, I fully agree. But we're going to do that anyway because we're going to give you a couple of plays of the day now. Right, me first as usual. Well, that short cable position, well, it worked when I wrote these notes because I wrote them yesterday morning. But by the time the market closed yesterday, we were back at about 124-ish. So, yeah, it depends where we would have closed that one out. But let's put a green check next to it anyway. This week, I'm going back to my first play of the day of the year, actually, which didn't work out at the time, which was to be long of volatility. Now, of course, when Trump came in to the Oval Office, we were sat here and we were saying, volatility looks a little bit subdued, but actually that was proved correct because it turned out that Trump's bark on the campaign trail was worse than his bite in office, at least during the first week. But now that he's settled into the Oval Office and tariffs are being thrown around left, right and centre, I think it is time for markets to reprice higher volatility, not just in the equity complex, but really across the board. Actually, I still am of the view that I think the VIX should be trading considerably north of 20 and probably will spend the bulk of the year above that 20 mark as financial markets adjust to this barrage of news flow that we're getting on pretty much all subjects, to be honest with you. I mean, Trump held a press briefing yesterday, which was supposedly about tariffs. He ended up creating a sovereign wealth fund in the United States. I mean, who the hell saw that coming? And that's just the degree of unpredictability that participants need to adjust to. And I think the market still needs to adjust to that as well. So being long of volatility, be it equity or fixed income or foreign exchange, is what I am trying again this week. Ryan, the S&P 500.
Yeah, and this is a bit of a try again trade as well. This is a break trade. I tried last week when it actually failed. I've left it alone since when we had that move up last week through that 6100 level. But the price action for me still looks very bullish. So I'm looking to perhaps try the break trade again. Now that 6100 level is the key level. And with those two prior highs just coming in shy of 6120, that's sort of the new level I want to see break moving forward. There's two possible ways I'm looking to play this one: either a break of 6100 that then holds as support, or a straight move through 6120. So, yep, giving this one a go once again if it happens.
Good stuff. Right, well, let's see if our second attempts at these trades are any better than the first attempts that we had earlier in the year. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully, what we've recorded stays valid for more than about half an hour, and you do get the chance to enjoy the show. And if indeed you do, please do drop a like on the video and leave a comment as well. Let us know how you're viewing the markets in these very uncertain and volatile times. In any case, myself and Ryan will be back with another episode of The Trade-Off this time next week. In the meantime, a very good week ahead, and we will see you then. Thanks as always for watching. Goodbye for now.